We're back with Jeff Schulze, Head of Economics and Market Strategy at Clearbridge Investments. Jeff, thanks very much indeed for sticking with us and helping us to kick off the week here. Give us your take, I know it's a very broad question, on the Mag 7 stocks, given the rise of cheaper AI technology from China. Is this a major problem?
Well, I think it's obviously an impediment for U.S. markets over the next quarter or two. We've been advocating since the beginning of the year that the Magnificent Seven would underperform this year from dynamics that were known or either unknown. For example, DeepSeek came out of nowhere, really upended the future path of AI and what's embedded into these perceived bulletproof leaders. So it's a catalyst that's unknown, and I'm sure there's going to be a number of different catalysts on that front that change as we look forward and AI evolves. But there's also catalysts that are hiding in plain sight, and two of the ones that we were cognizant of is the fact that if trade wars started to ratchet up in a more meaningful fashion, the Mag 7 has much more exposure overseas than other companies. In fact, they get 55% of their revenues overseas versus 35% for the rest of the S&P 500. And then small and mid-cap stocks get less than 25% of their revenues overseas. So this is one of the drivers of the Magnificent Seven's large underperformance that we've seen over the last 5 weeks, but also a key driver for other areas of the market that have lagged this cycle. So small caps, mid caps, the rest of the S&P 500 is the fact that in 2025, earnings expectations for these other lagging areas are going to catch up to the Magnificent Seven, and the Magnificent Seven is not going to have a huge earnings advantage, which has been a fundamental driver of those stocks over the last couple of years. So, well, we don't think the Magnificent Seven stocks are bad stocks. We think it's a stock picker market where you really need to understand what's embedded into these stocks, what competitive advantages they have, and active managers that can sidestep some of that concentration risk are going to have a core competitive advantage to create alpha over the next couple of years.
You like the look of Europe. Tell us why.
Well, there's a lot of positive dynamics that have come out of Europe here recently. First off, if you look at their earnings revisions, started to turn positive in November. That is usually a good sign for relative outperformance and absolute upside, and we've obviously seen that transpire. There's a bit of a peace dividend that's being priced into the region. So some of that valuation discount that you've seen with European equities and global equities is starting to get a little bit more compressed. They're still cheap historically, so there may be room to go there, but that's obviously something that has created some upward momentum. And then last week, we got some news from Germany that they're working on a large $500 billion infrastructure package. They're going to increase defense spending, and it's not going to count to the debt brake. So they're really starting to do fiscal stimulus. And you could look to the U.S. over the last 10 years and how powerful fiscal stimulus has been for our economic growth and our earnings delivery. So if you put this all together with potentially China doing a little bit more on the stimulus front, now that tariffs are directly focused at them, that's a really strong concoction for positive price action. And although we may need a break from the move that we've seen over the last month and a half, I think that there's probably more upside in this trade as we look forward over the next quarter or two.
Is there an area in, just to flip back to smaller stocks and mid-sized stocks in the United States, are there sectors or industries that attract you right now?
Yeah, well, if you look at technology and biopharmaceuticals, if you're going to have a more robust M&A environment, those are going to be areas where you're likely going to see M&A activity, especially with all of the cash that are on larger company balance sheets right now. I am optimistic on the prospect of financials and in banks in particular. If there is going to be a genuine deregulatory push in those areas, that should be able to increase the bottom line of those companies that have been ground zero for regulation ever since the global financial crisis. And with the pullback that we've seen in financials and banks here recently, I think that represents a really good buying opportunity. And once we get past this growth scare, I think there's going to be much stronger credit growth and loan creation in the U.S., which is going to juice the bottom lines of banks. So I think there's a lot of opportunities to be able to play in the small cap and the mid cap space as we look forward over the next 12 months.
And just you touched on this theme, but you do have an interesting stat for us. Since 1989, quite a few decades, when the S&P's top 10 has been 24% or more, which it is right now, the equal weight S&P 500 has outperformed the regular S&P 500, you say, almost all of the time over the next 5 years.
Yeah, market concentration can stay elevated for a period of time, but generally speaking, you do get that reversion to the mean with the average stock outperforming. And the top 10 names make up 37% of the index, and when you've been above 24%, so we're well below that threshold. The equal weighted index, or the average stock, outperforms by close to 7% per year over the next 5 years. And as you mentioned a second ago, the hit rate of that average stock, or the equally weighted index outperforming, is close to 95%. So again, it could be the catalyst like DeepSeek that we don't see coming, or some of these known catalysts like elevated international revenue or better earnings delivery that create this rotation. But we believe that we're in the early innings of this rotation out of those winners that we've seen over the last couple of years and into other areas of the U.S. equity complex.
We've only 30 seconds. Give us your view on bonds. Would you be a buyer of the U.S. 10-year bond right now?
I think the 10-year Treasury is going to be range-bound over the course of the next 6 months. I could see it easily going below 4% if this growth scare does continue and you see higher volatility, especially tied to tariff uncertainty. So if I had to pick take on duration or no duration, I take on duration at this point. But I don't think the 10-year Treasury is going to get much lower than 4%, just given the underlying trend that we have with nominal GDP growth in the U.S. at around 4.5%.
Jeff, thank you very much indeed for joining us this